Do you think life is simpler as time evolves? For some, it can be more complicated when facing issues about health, estate plans, probate, long-term care, and more. That's why Attorney-CPA Joe Cordell hosts ElderTalk with TuckerAllen, providing intelligent answers for those thinking about their future. Here's Attorney-CPA Joe Cordell.
Welcome to another episode of ElderTalk. This week we have a guest that I think that you will find very interesting. In fact, a guest that you may have heard from before. I think it's not an overstatement, Jill, to say this is a legend in the financial advisory field.
I think that would be accurate.
Yes. How many of you have heard of Ric Edelman? Well, Ric he's ubiquitous around, I guess, financial markets. He gives advice, and he also does analysis, and he's just kind of an authority on markets as well. And he does kind of advice for personal financial planning, which is a little bit of a broader topic than simply the subject of investment. And I think for that reason, this is the perfect guest for this audience. So let's go ahead and get started. Ric Edelman, welcome.
Oh, it's good to be with you. Thank you, Justin.
And it's Joe, but that's okay.
I'm looking at two different names. I've got Justin on the engineering side, and I've got Joe on camera with Jill.
Well, you were close,
all those
actually.
J's, right?
Yeah, you were close, actually.
Easy to get confused.
Justin's next door.
You want to call this the Triple J Show?
We should. That would be a good name.
You know, if we could. I tell you what, if we could figure out how to give advice to this audience that they could plan their lives better, our audience would probably quadruple overnight, because everybody is hungry, especially people, and you may know this, Ric, our audience is comprised largely of people who are over 65. As a matter of fact, I would say 90% of our audience is over age 65. So the thing that we talk about often on this show is the fact that you have some margin for error when you're younger. You know that you can make some mistakes, and we all do, but you figure, okay, so I'll take a step back, I'll correct for that mistake, and I'll be okay in a few years. But the margin for error for people as they age is so small, and now we've thrown in this 100-year flood or 1,000-year flood scenario that we've seen in the past, 16 months. So people are wondering, where do I go financially? So I guess I'd like to start the show by getting your thoughts about the economy generally as you look forward. I realize nobody has a crystal ball, but what do you think lies ahead for the next 8 months or so?
Well, it's hard to say, of course, because there's so much conflicting data coming out from government as well as the corporate sectors. And differences between the U.S. and foreign markets. And it is a one world these days economically. We're all intertwined due to foreign trade. So it's really hard to pin it down. At the moment, things are looking very rosy. We are coming out of the pandemic. Jobs are coming back. Inflation is creeping up, but interest rates remain very low. The government stimulus is still very recent, and there's more to come, anywhere from $1 to $3 trillion more, depending who you talk to. And that is flooding the economy with a massive amount of cash, which is filling everybody's pocketbooks. Incomes were up 21% in March, the highest gain since they've been recording the data since World War II. And it's all because of the government stimulus. More Americans are now making more money through the stimulus than they were from working. So what's not to love? Everybody's got a lot of money, and we're seeing it reflected in spending. People are buying homes, they're buying cars, they're buying refrigerators, they're starting to travel again and going out into the society with restaurants and so on. We're seeing ballparks open up. Broadway's going to open in the fall. So for the next 6 months, 8 months, it's all looking good. The question is, what happens when the stimulus runs out? What happens when the eviction moratoriums go away? What happens if consumers aren't willing to go back onto airplanes or cruise ships? What happens if the virus resurges like we're seeing in India? So, and what happens when Joe Biden creates his new tax law, which he's threatening will have $10 trillion of new taxes over the next decade? So next 8 months, not looking so bad. Beyond that, it's a toss-up.
So for people in the category that I described, people who are 65 and older, with the limitations they have in planning. How do you advise people in that scenario to deal with what little funds they may have right now?
Yeah, well, our client base is not very different from yours. We're the largest independent financial advisor in the country with 1.3 million clients around the U.S.
Wow.
Managing $260 billion in client assets. And a great many of our clients are in retirement. So we're dealing with this issue all the time, just as you are. And the one message that we constantly have to reinforce for our clients is the exact opposite of the question you asked me to start, which is the next 8 months don't matter. I really don't care what happens in the next 8 months. I'm not terribly concerned about Joe Biden's tax increases because I'm concerned not about the next 8 months or even the president's next 8 years, assuming he's reelected. I'm worried about the rest of your life. If you're 65, chances are you're going to live 30 to 40 to 50 more years. You're barely in the high side of middle age.
That's a shocking way to think about that.
Yeah, it is.
Because when we grew up, when you were born, 65 meant death. You know, people retired at 62, they were dead at 65. Today, you're healthier at 65 than your grandparents were at 45.
People are living longer, absolutely.
And medical technology and innovation is going to continue that even further. That's the basis of my most recent book, my New York Times bestseller, The Truth About Your Future, about exponential technologies, artificial intelligence, robotics, AI, nanotech, biotech, bioinformatics, fintech, edtech, big data. All of these innovations in technology are causing massive improvements in medical technology, which means we're curing the diseases that are constantly killing people today. They're all going to be cured over the next 10 to 15 years. So people who are likely to live to 85 today, if you're alive in 2030, you'll probably live to age 110 or 120. So if you're 65, 75 years of age, don't worry about Joe Biden's tax increases. He'll be out of office long before you're dead. You need to be focusing on your true long-term investing, just as you did when you were 30 and 40 years old.
Yeah, and that's hard to get our heads around because we have such a stereotype indelibly planted in our heads that you start winding down at 65 and you hope for maybe 20 years. But I think you're right. I think the demographics are going to radically change.
People don't want to retire in their 60s anymore because they feel physically fine. They want to continue contributing. They have a wealth of knowledge and experience. They want to share with others. They want to continue to contribute into society. We are more social beasts when we're working and engaged, even if that work is part-time, even if it's charitable or philanthropic. We want to continue doing these things. So the word retirement is fast becoming obsolete and out of date. We need to recognize you're going to leave that full-time 60-hour-a-week job, but that doesn't mean you're going to sit home and watch TV all day and eating bonbons. You're going to do something to replace that time because you're vital and physically fit, mentally alert, and you're going to want to continue doing that. And you'll do that in your 80s and 90s.
And that was a bad idea all along, if you think about it. This idea that you stop and sit down for 20 years and wait to die.
Yeah.
You know, it was always a bad idea.
Well, it was never really a valid idea, not just merely a bad one. The notion of retirement, as we understand it, where you retire at 62 or 65, you get a gold watch and a pension, that only originated in the second half of the 20th century. In the 1800s, if you were alive, you worked. You either shot or grew your food, and you had to work to survive. The notion of a retirement didn't exist. You come out of World War II, you have the notion of the industrial age, everybody working in factories, not on the farm, in exchange for a paycheck. And that factory life was brutal, very difficult physically. And people got to the point of womb-to-tomb employment where they retire after 40 years. They get that gold watch and a pension. They have a mortgage, but it's paid for after 30 years. They own the home outright. And they are now 60 or 62 years of age, and their life expectancy is 3 more years. So they loved the idea of finally relaxing for a few years before they died. But you fast forward and people weren't dying in 3 years, they were living for 30. And no one ever prepared them for that. And they're sitting around saying, this can't be it. And now that's to your point. It was a bad idea. Our country has outgrown it, and we need to recognize it individually so that we can begin to plan the next chapter of our life. Because when we're 65, we're only 2/3 done.
Right.
And the effects of an actuarial miscalculation, which people who are setting on a pot of money primarily as their source of support in the future, putting aside Social Security, because many of them in the last 20 years or so saw those traditional pensions go away. So they're trying to amortize or allocate that money for the balance of their lives. And you could easily make a calculation error and end up, using your last portion of your money when you're 87 years old and still feeling pretty good.
Right.
Those formulas
That's the real
don't.
crisis, is that people are projecting a 20-year retirement into their 80s, not realizing they're likely to live into their 90s or beyond. My mom recently passed at age of 93. My grandmother lived to 101. We need to recognize this is increasingly common. And as a result of that, you have to make sure if you're going to live this long, will your money last as long as you do?
And also preparing for long-term care. Just because you're going to last that long, that doesn't mean, say, the last 10 years of your life, you're going to be in good health. You may require extra health care, such as long-term care.
A very good friend of mine is Ken Dykewald, who I'm sure you know, the founder of AgeWave, the nation's preeminent expert on gerontology and longevity. And Ken acknowledges in his 17 books that we spend the last 10 years, 15 years of our lives not living, but dying. We don't have an effective system in our nation for helping people age with grace and dignity, so that we are vital and vibrant in our final years, as opposed to on this slow decline, which is incredibly expensive. Long-term care and medical care and expenses cost the average 65-year-old over $250,000 in their retirement. And it is the number one cause of poverty among retirees. The fastest growing age group for bankruptcy in America are the 65 plus cohort. Because people are living long. They didn't expect to live this long. They didn't expect to be incurring this major expense in healthcare and long-term care, and they're simply not prepared for it. And it's a crisis of epidemic proportions because it's affecting so many retirees, and by extension, their children and grandchildren who are footing the bill for their parents' and grandparents' care. And it's a real problem for society.
Yeah, and some would think that is inconsistent. That, on the one hand, we would say, well, gee, we have this technology and capability, and we're actually seeing people live longer. And on the other hand, we have these huge social health issues, right, such as type 2 diabetes and the fact that we're, 70%, I heard the other day, 70% of Americans are overweight. And I think 42% are obese. That's a shocking number. But those two facts are not inconsistent. Like you said, we have the ability to keep people alive, albeit in this decrepit, expensive, ineffective way. And the trick, it would seem, is for, in addition to having this capability to extend lives, for people to govern their health better.
Right. And I'll give you a little more of a narrow focus Jill will be nodding her head throughout this entire commentary, that this whole subject of financial planning, retirement planning, aging is essentially a woman's issue. Women earn less money than men when they work. They spend less time in the workforce, largely due to caregiving. They're raising children on the early ages, and then they're caring for parents on the elder ages. And so they spend less time in the workforce. They earn less when they do work, so they accumulate less money in their 401k. They qualify for lower Social Security benefits. They rarely qualify for pensions as a result of all of this. And yet, women live 5 to 7 years longer than men, which means the wives are outliving their husbands. They tend to be 1 to 2 years younger than their husbands anyway, and they live 5 to 7 years longer, which means they are spending 7 to 9 years as a widow, or divorced, or unmarried. And as a result, women are facing much more of a crisis in this issue than men, because the men have died. That kind of solves all your problems. But the women are still alive, having to deal with this issue, and often many of them for the first time alone in dealing with these challenges, unprepared educationally and unprepared financially to deal with something they never had to experience before, because their parents and grandparents never went through it, so they never had that experience and didn't know it was going to happen to them. And this is why we focus very heavily in our practice on the women among our client base, not just the couples, which are very important, and not just the men, but this is very largely a women's issue.
Well, given your large client base, I'm interested in the things you encounter as well as the advice you give. would you think that it would be a sound policy to encourage, as a general rule, recognizing exceptions, to encourage people to just presume that when they reach a certain age that they leave perhaps their main career with the expectation that they're going to choose something else to be employed? Because it addresses the financial problem, one might argue, as well as the mental health and maybe even physical problems to the extent they're required to move around. But choose a job that they really enjoy.
Yeah, you're absolutely right. And here's the good news about it is that if you're 65, you don't have to continue working another 10 years at your grueling job, 60 hours a week. What our research has shown is that just working 1 or 2 extra years is enough to allow your money to last an extra 10 or 20 years longer. It's amazing how an extra year or 2 of savings, of compounding, with a 1 or 2 years less of longevity can be enough to make a material difference in your ability to generate the income you need in retirement. At the same time, doing a gig, meaning go get a part-time job, anything from Uber and Lyft to working in a fast food joint to doing something that you want 10 or 12 hours a week, making 10 grand, 20 grand a year. You don't have to make 80 grand, 100 grand. You make 5, 10, 15 grand in a year. Use that to supplement your retirement income. You'd be amazed how much longer that will allow your lifetime savings to last. So subtle, small changes can have a profound impact on your financial security.
Ric, your show just celebrated the 29th anniversary. Congratulations, by the way. And you
nationally syndicated, right?
Yeah.
Yes,
we air in 100 radio stations around the country.
And you mentioned the top 29 tips over the years. Can you just give us a few of those highlights?
Sure. There's, the one that I think would be number one on the list, meaning the earliest one that I came out with 29 years ago that was very controversial at the time, still a little bit so, but not as much, is very simple. You should get a big, long mortgage and never pay it off.
Why is that?
It sounds counterintuitive, doesn't it? Because we're all born and raised to believe in the American dream, home ownership, and owning your home outright's the American dream. Don't have a mortgage. In fact, I've now got 11 great reasons to carry a big, long mortgage. It's counterintuitive. In fact, with today's low interest rates, having a mortgage is actually a smarter, safer way for you to achieve financial security. Because if you're going to pay that mortgage off, you've got to give hundreds of thousands of dollars to the lender. That's money you'll never see again unless you sell the house. You might have the house paid for, but you still have to pay for insurance and taxes and maintenance and repair. Even though you don't have a mortgage payment, you're not going to get rid of the monthly costs. And if you give away all your money, you've seen it as well. People who are house rich and cash poor,
right?
They might not have a mortgage payment, but they're struggling to buy food and medicine and gasoline for their car. So having a mortgage lets you keep your cash. And by keeping your cash, you're able to pay your bills, maintain your lifestyle, and make the monthly mortgage payment, which is no big deal. There's no problem to have a mortgage. The risk is having a mortgage you can't afford. As long as you can afford it, a mortgage is actually a very
living beyond your means. Yeah.
Yeah, and right. I didn't know this, and I read this not long ago, that apparently the United States is the only country in the developed world that has 30-year mortgages. The reason is that it's not financially sound for a person to lend, for a lender to say, I'll give you a mortgage, grab 4%, and commit to only get a 4% rate or that turn for 30 years into the future. Right. It's just really a bad decision for a lender, but we're used to it in America. It's partially subsidized. Much of it is subsidized through FHA and whatnot. So we have this tremendous bargain opportunity to lock in rates for a long time that give it. Finally, inflation's returned. And I rejoice in a way because I missed inflation for the last 30 years. And I'm old enough to remember, you may be too, Ric, when inflation was your friend if you were buying a house. And you'd get a fixed mortgage and that house be worth 3 times its price or its value.
Back in the 70s?
Yeah, 70s were the big era for inflation. But so you think then that there will be, in addition to the other reasons you mentioned, do you think that inflation may also be an additional incentive to get a fixed rate mortgage now?
Yes. I mean, if we are expecting inflation, we're already beginning to see it as the economy is recovering. Higher inflation on a sustained basis translates into higher interest rates. So wouldn't you love to lock in today's rates, which are at historic lows, lock that in for 30 years? To me, that's a heck of a bargain that won't be available forever. And that's why we've seen a huge increase in refinancing over the past couple of years, because homeowners realize they can radically reduce their monthly expenses, lock that number in for 30 years. As the cost of living rises, that payment looks less and less. I remember my dad laughing at me when I bought my first house with my wife back in 1987. Our mortgage was 12%.
12%.
And my father was laughing at me because he had a loan from the GI Bill, and his monthly payment was like $130 a month. But he said to me, when I first got my loan, he said I could barely afford that payment. But over time, because it was a fixed rate, that $130 never rose. It was the same 130, but his income kept rising with his career. So the 130 essentially got cheaper and cheaper and cheaper relative to the cost of living. And that's the tremendous advantage of fixing your loan cost in a rising cost economy. So people should take full advantage of this. And if you're saying to yourself, gee, I'm already in my 60s, why would I want to get a 30-year loan? Because you're probably going to be alive in your 90s.
Yeah. And most people just can't imagine that. But I think it does lie ahead for many people. So when you're talking to one of your clients, or perhaps somebody who calls into your show, and they have, for example, $1 million and they're 65 years old, you would probably suggest to them they should probably plan on working some, but I suspect for reasons in addition to the amount of money they have. But how do you give them guidance as to how to allocate that money? And I mean just in broad terms.
Okay. Well, it's really fascinating. Everybody always wants to know, where should I invest my money? And I've been managing money in our firm for decades. Don't look at the markets. That's the mistake most people make. What's hot? What's not? What can I get into now? How can I make money on this investment? The key is to recognize nobody can predict the future. Market volatility is a fact of life. We only know two things. Number one, over very long periods, 10, 20 years and longer, the financial markets, the stock market, the real estate market tends to do well, meaning that I'm confident in saying that the stock market will be higher 20 years from now than it is today. I don't know about 20 days or 20 weeks, but I'm pretty confident about 20 years. So we have to have a long-term perspective. But in the meantime, it's volatile. Look what happened in 2008. Look what happened in 2001. Crash of 87. I mean, there have been a lot of crises where the markets have done terribly. Look at a year ago, the markets fell 35% in 6 weeks. So in any short period, who knows what's going to happen? And therefore, instead of looking at the markets, look at yourself. Focus on you. What are your goals and objectives? Tell me how much income you need. Tell me how much money you have, and I'll tell you if the amount of money you have is enough to produce the income you need. If it is, then we're going to invest very conservatively, because there's no reason to take any more risk than is necessary to achieve the goal. So it's not a question of how much money can I make in the market. The question is, how much money do I need to make in order to maintain my lifestyle for myself, my spouse, and preserve an inheritance for my children? Focus on you, your goals and objectives, your need for income, your need for liquidity, your attitude about risk. Focus on you, and the answers become clear.
Ric, I have to ask you, we've had a couple of shows on Bitcoin, and I just wanted to know what your thoughts were on that type of investing.
I've been heavily involved in the digital asset space since 2012. And I'm the founder of the RIA Digital Assets Council, which is an organization that teaches financial advisors about blockchain, Bitcoin, and digital assets. So I'm a very big fan of this technology. It is transformative. We have to recognize, however, that it is still, although it's entering the mainstream, everyone's now heard of it. You see it on page one in newspapers all over the place. It is still emerging, which means it's still developing. And that means remains a lot of uncertainty. And uncertainty translates into volatility. We saw in the last week, Bitcoin fall 50% in value, and then jump 30% in value. That's not uncommon. Bitcoin has a tendency to do that, and so do other digital assets. So you need to take the same approach that you apply to the rest of your investments. If you are willing to take risk, then I believe a 1% allocation of your portfolio Meaning if you have $1 million, 10 grand in Bitcoin and digital assets might be appropriate. Because what we've learned historically is that the volatility means small investments can produce a meaningful return. But if it goes bad, if there are problems and it loses money, it's only 1% of your portfolio. It's not going to hurt you if it goes wrong. It's kind of like a lottery ticket. There's nothing wrong with buying lottery tickets. Just don't buy only lottery tickets. If you buy one, no harm, no foul, because it'll probably be worthless. On the other hand, it might be worth $1 million. So buy one lottery ticket. Don't put your whole life savings into lottery tickets. And Bitcoin is similar.
So what about precious metals? Would that be the same analysis that you would approve a 1 or 2 or 3%?
I would probably go higher, only because you don't have the price expectation on gold that you have for Bitcoin. In other words, there are a lot of folks who believe that you can see a 5x or 10x return on Bitcoin. They could grow 1,000%. Nobody's really expecting that out of gold. So 3 to 5% for gold would make more sense. Again, not because you're predicting it's going to grow in value, but because a truly diversified portfolio owns everything. Own it all the time. You shouldn't be trying to guess which horse is going to win the race. Bet on every horse and own stock on the racetrack besides. If you own it all the time, the average returns will likely be enough for you to meet your financial needs.
But I'm willing to bet, though, that you and your investment advisors, your analysts, et cetera, you don't do that blindly, where it's just a distribution across all sectors. I suspect that at any given time, you have confidence in certain from a macro level, in certain areas versus others.
We do not believe in sector rotation. There are some advisors who do that, where they'll shift from tech stocks to airline stocks to hospitality stocks to medical stocks to industrial stocks to foreign stocks, and they will rotate from sector to sector based on what they think is coming next. We don't believe in that philosophy. We don't believe that there's any demonstrated history of anybody being able to do that successfully over any long period of time. Instead, we believe in broad-based global diversification. There are 16 or 18 major asset classes. We believe in owning a wide array of those asset classes. They have different levels of risk. So the mixture of them, how we slice our pie, will be based on the client's risk level and need for return. And then we'll periodically rebalance that portfolio. Rebalancing is a key element that most people don't engage in the correct way, if at all. By rebalancing, instead of trying to guess what's going to do well, you wait for it to happen. And after it happens, you rebalance. I'll give you a quick illustration. Let's say that we start with just 2 assets, 50-50. We put half our money into each. We know that one of them will do better than the other, but we don't know which. Eventually, one will do better, and now we're 60-40. We sell some of the 60 and we buy some of the 40, so we're back to 50-50. What we've done is we sold high and we bought low, without having to make any predictions or guesses.
But what America does is the opposite. When they see the 60, they say, oh, wow, that's good. Let me take the other 40 and put it in the 60.
You're exactly right. And they buy high and they wonder, and they buy high and sell low, and they wonder how they argue that the market's rigged. You can't make any money.
So how do you give your investors value then? In other words, you're not simply saying that you can, in a mechanical way, just do this allocation unthinkingly across all these sectors in equal proportions, even with the rebalancing.
Well, it's really interesting. You're asking a really, really good question, because the investments that we give our clients, we use mutual funds and exchange-traded funds. And there's nothing special about them. They're available from everybody everywhere. We don't manufacture our own products because that's a conflict of interest. We use the products that are available in the marketplace from State Street and BlackRock and Vanguard and Fidelity and others. So why does somebody need to hire me? They could just go buy those mutual funds and ETFs on their own and avoid my fee. Why don't they just do that? There are 3 reasons why people hire, not just my firm, but advisors in general. And it's the same with lawyers. It's the same with accountants. There are 3 reasons people hire professionals like us. Number 1, lack of knowledge. I don't know how to buy it. I don't know which ones to buy. I don't know how to research them. Number 2, lack of time. It takes time to do that research, to open the account, to make the trades, to monitor the portfolio on a daily basis and rebalance it as needed, to handle the record keeping and tax reporting. It takes a lot of time to do this. A lot of people don't have the time. I already have a job. I don't need another one. And number three, lack of desire. Even if I have the knowledge and the time, it doesn't mean that's how I want to spend my time. I'd rather be playing with the grandkids. I'd rather be playing golf. I'd rather be, doing something that's fun than these chores. It's like hiring somebody to change the oil in my car. They're not going to give me better oil. They're just going to do it for me so I don't get my hands dirty. And I pay a fee for the service.
And for the skill.
Yeah, exactly right. So we're going to do it. We're going to do it right. We're going to do it easy. We're going to avoid you from getting involved in the chores. And oh, by the way, we're going to give you advice in so many other areas that have nothing to do with that investment portfolio. Mortgages and taxes and insurance and your 401k and employee benefits at work. And you were going to deal with family issues, helping aging parents and children with college planning. We're going to deal with retirement planning and estate planning. Everything with a dollar sign. You ready to buy a car? We'll help you with that. You're saving for a daughter's wedding? We'll help you with that. So that's why people hire folks like us. It's not because they can't. It's because they don't want to.
But, there aren't a lot of places that do well, at least, investing as well as financial management or personal financial management or advisory. I think that many stock I don't want to say just brokers, but people who hold a Series 7, for example, they'll purport to be a financial advisor, a personal financial planner. But in reality, they're not financial planners. They may be good in their own area, but financial planning is different. And through your firm, you're doing both what would be considered investment advice as well as personal financial planning.
You're right. And it's all too true that is often the case. And that's why our firm was named the number one firm in the nation by Consumer Reports for quality, and why we are ranked the number one firm in the nation by Barron's as well. So yeah, you're right. There aren't very many. There are some. There's no question. There's a lot of talented financial advisors out in this country, but there aren't as many as there ought to be. Frankly, it's a growth industry. If someone's looking for a new career, there's a big demand for help among consumers. And we have a good reputation for providing that help, and we're proud to be able to do so.
So tell me how your charges work, your billing. How do people pay for your services?
Well, our standard fee is $800 for a financial plan. That's a one-time fee. And through that financial plan, we will go through every aspect of your financial life and help you figure out, here's where you are. Here's where you want to go. We'll map out the plan to get you from here to there. It's really that simple. We do all the hard work, all the number crunching. All we need is for you to give us the basic info, which we collect over a course of a conversation. Mm-hmm. The financial planning process is typically a couple of meetings with you that are an hour to 2 hours long, depends how much there is to talk about. And then we go to work and do everything for you so that you don't have to waste time dealing with it. You're not abdicating to us, you're delegating. So you're involved in the process, but you're delegating the chore to us. So it's sort of like we're the chef, you're telling us what to cook, but we're going out and buying the ingredients, we're doing all the cooking, we're in the hot kitchen, and we deliver for you the fabulous meal. And then if you want us to manage your assets, we charge an asset management fee. The fee is based on how much money you invest with us. The more you invest, the lower the fee. And so we don't charge commissions. We are a fiduciary, like an attorney is, where we are legally obligated to serve the client's best interest. So we minimize our conflicts wherever we possibly can. So we're not selling products, we're not selling insurance, we're not earning commissions, our financial advisors, to do that kind of thing. We're paid to give you advice, and the sole income we get is the fee that our clients pay us.
And your path to financial planning, it wasn't typical. If you could share the story about how you and your wife, Jean, got started, I believe, giving presentations in schools.
What year? And tell us what year was this? How long ago was this?
This was, we started our practice, my wife and I, in 1986. As a result of a really bad experience we had. As a young married couple, we wanted to buy a house like every other young married couple, didn't know how to do it. So we went to a financial planner for advice. And he ended up telling us to commit a felony. He told us to lie on our mortgage application in order to qualify for the loan. And we were so astonished that he would tell us to do this, that we said, you know what, we're going to learn how to do this ourselves. And then we're going to teach others what we've learned to protect them from guys like that. And so Jean quit her job, went to work for Payne Weber in their back office to learn the back office of Wall Street. I got licensed and we began by giving advice to folks. And we started by saying, we're going to help people who don't have access to advisors. I mean, rich people, they got as many advisors as they need and want. But young folks who don't have a whole lot of money, where do they go for advice and help? Other than insurance agents and stockbrokers who are trying to sell them something. You don't want to ask the car salesman whether or not you should buy the car. Bad outcome. So we started by doing college planning seminars for elementary school PTAs and teaching young parents of young children why they needed to start saving for college that was 10 years, 15 years away. And this was back in the 80s when no one had ever heard of retirement planning, college planning, retirement planning, financial planning. It was unheard of. And we had to explain to them why they needed to care, why they couldn't wait for their kid to be a senior in high school to worry about college. They needed to think about it when the kid was in kindergarten. And so we did those seminars for years, pretty much to every elementary school in the area. And word spread, I got invited onto the radio, and that led to my radio show, and then television shows, and now 10 books. I'm a #1 New York Times bestselling author. I was on Oprah 5 times, and on and on and on.
Huh, that's quite a story.
Isn't that interesting?
So did you have any sort of financial background when you decided to teach yourself?
No, and that was the funny thing. Most folks in my industry have they went to business school or a degree in economics.
You were what, mass comm?
I was my degree's in communications.
Right.
And so I think that was my advantage. Is that in school, as a journalist major, they taught me how to ask smart questions and how to explain the answers in plain English. So people would say to me, here's what you do. And I remember very first off saying to folks, why are you telling people to pay off their mortgages? And the answer I got was, because it's always been that way. It's like, that's not an answer. So I did my own research, common sense with a spreadsheet, figured out that I didn't like the answer of paying off a mortgage. My math said something different. And I was able to communicate and explain this to folks on the radio in a manner that was common sense and plain English. And people really enjoy the message that makes sense. It's actionable and it's easy to do, easy to sustain and maintain, and it helps people achieve wealth. So what's not to love?
And that's a great story. And I really wanted to emphasize something that you mentioned, and we've brought it up a couple of times on this show before. A lot of people just don't appreciate the fact that the phrase investment advisor is used very recklessly. And that many times people who are, as you said, selling a product, they say that they're financial advisors. But
well, the insurance agents say that because if he said, I'm an insurance agent, you'd run away.
Yeah. Right. And what's scary though is that many times people think that this person is making disinterested recommendations, objective recommendations, that they're acting as the phrase you use, fiduciary, and when in fact they're not. So they have an interest not in selling, not simply is the issue insurance, but they have an interest in selling permanent insurance virtually 85% of the time. That may have changed somewhat in the past few decades, but historically, the big money is made in this high front-end commission that you earn if you sell permanent insurance.
So if you want to watch people's heads explode, just ask them the question, let's say that you buy a whole life insurance policy and the premium for the policy is $10,000. What is the insurance agent's commission on that $10,000 premium? What percentage commission will the agent earn? I'll ask that you probably, in your experience, know what do people commonly answer to that question when you ask them? How much is the commission on a $10,000 policy?
They'd probably think it was 10%, maybe.
Exactly. And in fact, of course, the actual commission can be as high as 120%. The agent can earn a $12,000 commission on a $10,000 policy. That gives the agent a pretty strong motivation for persuading you to buy it. And that's what consumers don't understand, because when you buy a car, the price tag is slapped on the window under government regulation. But the commission for buying that insurance policy, nowhere to be found.
Yeah, and a similar thing with annuities. I mean, these are all products that pay huge commissions on the front end, and the consumer doesn't realize it, and they think they're getting the sort of financial planning advice or personal planning advice, such as what you guys would charge maybe on an hourly basis. I've been an advocate, though, of hourly billing when it comes to that sort of planning, because then there are no conflicts, right? Or
And
a flat fee.
There are a number of advisors who do operate on an hourly rate. Our firm does it on an asset management basis, but there are a number of advisors who do it on an hourly rate. So it's best for you to shop around. And in fact, at our website at ricedelman.com, we have a brochure called How to Choose a Financial Advisor, a checklist of the 11 questions you should ask. And you should interview 2 or 3 advisors, compare the answers to help you decide if you're hiring the one who's right for you. It's amazing. We know how to shop for refrigerators and automobiles, but nobody knows how to shop for a financial advisor. It's not very difficult, and you should use your common sense and ask smart questions.
Well, I think people assume that they're going to a financial advisor, that person will have their best interest at heart, and they're going to give them the best financial advice because of their so-called title. But that's not always the case, and that's why it's so important, I think, that you ask about their credentials.
You're absolutely right. What most people don't realize is that there are 3 different regulatory bodies. There's the SEC, FINRA, and state insurance regulators. You have insurance agents, stockbrokers, and registered investment advisors, RIAs. And of the 3, only the RIAs who are registered with the SEC, only they have the fiduciary standard. Stockbrokers under FINRA do not have a legal obligation to serve your best interests when they're simply selling you products. And insurance agents, the same thing. So the only way for you to be sure that you are dealing with an advisor serving your fiduciary best interests is for you to ask them that question. Are you a fiduciary? They're going to say yes or no. And if they say yes, prove it. Show me your Form ADV, which is the written disclosure document we have to provide all our clients on an annual basis. Stockbrokers and insurance agents don't have an ADV to give their clients.
Look, stockbrokers went nuts whenever there was this proposal that they become fiduciaries. There
was a demand in New York that the New York regulator imposed last year that would force all insurance agents to serve as fiduciaries. And the insurance industry filed lawsuits to block the new rule. And the court just a couple of weeks ago ruled in their favor and removed the rule from inaction. And as a result, you've got to ask the question, why would an insurance industry oppose serving the consumer's best interest? There can only be one reason.
Yeah. The fiduciary standard is the highest standard to meet in terms of selfless advice. I want to come back to something to make sure that this is understandable to our listeners. I think that it makes complete sense to have a percentage charge for the money that's managed. And I think of that as the investment management piece. And it makes complete sense to me versus paying commissions for in and out of trades, which is what stockbrokers have historically done when you're picking stocks, so to speak. So many people assume that they're charged commissions going in and out, but instead what you do is a method that is available among the more reputable and I would argue more robust financial planning firms. So, but I'm distinguishing that from simply sitting down and doing personal financial planning. And in your case, you charge an $800 fee, which makes sense. A flat fee is reasonable, and an hourly fee is reasonable for the personal financial planning piece. Right. What's not reasonable is someone tells you there is no charge. I'm not making any money, it would appear from this, and that's when they need to be cautious because that's where they're likely, as you said a while ago, products are being sold.
I once had an insurance agent say to one of my clients who he was pitching them an annuity, and the client came to me for a second opinion. And I said, did the agent tell you how much commission he was going to earn selling you this product? And the guy said, he told me, he said his commission is being paid by the insurance company, not me. Well, where does the insurance company get the money?
Yeah.
It's from the sale of the product. And
of course it is.
The deceptive sales practices that are all too common are allowable because there's no fiduciary obligation by these marketers. And until that is in place, consumers need to be aware of it so that your guard is up. And the simple, easy solution is to work with an advisor who is and acts as a fiduciary. Simple as that.
We have just a couple minutes left because I know your schedule's tight. I want to talk about your most recent book about your future, which I see behind you over your shoulder. Can you, you mentioned it a while ago, give just a very brief thumbnail overview of the book, if you don't mind.
Sure. The Truth About Your Future is all about exponential technologies. Thanks to computer advances, we are seeing an explosion in innovation unprecedented in human history, and it's coming at a very rapid pace. It's hard to believe that only 12 years ago, there was no such thing as an iPhone.
Huh.
It's only
That's
12 years
true.
old. That's just mind-boggling.
The old flip phone.
Yeah, in this pandemic, we came up with a vaccine in 9 months. That has never happened before.
No.
It has been how many years? 4 decades, and we still don't have a vaccine for HIV. So it took Jonas Salk 20 years to create the polio vaccine. 9 months for this. This is all due to advances in computer technology, artificial intelligence, machine learning, and so many other medical advances. So it's getting really exciting. This is why you're hearing about self-driving vehicles and drones that are soon going to be ferrying passengers from rooftop to rooftop. And why we're seeing massive changes in energy, going from fossil fuels to solar energy, wind and water energy. We're seeing vertical farms being built in urban areas. We're not going to be needing all the hundreds of thousands, millions of acres in America's farmland in the middle of the country, because we'll be building farms in cities. We're not going to be needing cows and chickens and pigs because we're going to be growing the meat in laboratories. We're already doing this. So this is exciting stuff, also a little bit scary. And so the book is all about what these technologies are, what's coming, how fast, and what does it mean for your personal finances, about choosing a college, choosing a career, home ownership, marriage, estate planning, and of course, investment management. The Truth About Your Future is the mere fact, as Leo DeRocher said, the future ain't what it used to be.
That's good. So that's a good note to wrap up on. So you're a marvelous guest, Ric. We appreciate your taking time to talk to our audience. If they want to watch your show regularly, I assume that through Spotify and other sources, if not directly through radio.
Yes, so the show is a podcast as well. It's the Ric Edelman Show, and you can download the show as a podcast. You can also listen live or live stream it, and the full schedule of the program is available at ricedelman.com.
Marvelous information. We hope that you'll take time to come back again in the future.
I would love to. Thank you.
Thank you, Ric Edelman. This has been another episode of Elder Talk. Till next time, take care.
You've been listening to Elder Talk with TuckerAllen, providing intelligent answers for those thinking about their future, with Attorney-CPA Joe Cordell. Sponsored by TuckerAllen, your estate and elder law advisors. For more information, visit TuckerAllen.com. Listen again next Saturday for another edition of Elder Talk with TuckerAllen. The choice of a lawyer is an important decision and should not be based solely on advertisements.